you want to Google something, like you can find it. But it's like, how do you put the pieces in the right order and become confident enough in your skills, create a plan, and then actually execute on the plan? I think that is the real public health issue here, because if we all knew how to do that,
Yeah.
we wouldn't see some of these, um, you know, public health issues that we are currently dealing with.
Yeah.
I probably opened up a big box, Pandora's box there, but yeah, we can dive down any rabbit hole you'd like to there.
Welcome to the Real Estate Mogul MD podcast. Thanks for tuning in and taking control of your financial future. This is a show where we not only motivate and inspire, we give you actionable, real-world experience to help you live life by design. You'll hear journeys and stories from other physicians, investors, coaches, consultants, and entrepreneurs. And now, here's your host, Brett Riggins.
Well, I'm as excited as I always am. I'm just on fire. I've got a great guest here today, and what an amazing conversation we had. Talking about building the stepping stones, building that foundation to take you from the idea of having a passive income portfolio to mastering it. And this foundation, maybe even going from single family and then scaling into multifamily and syndications, even car wash and debt fund. Man, we're going to touch on it all. Stay tuned. This conversation, really 7 key pieces of this. We're going to talk about the income centers of real estate and why it is important. Capital preservation, cash flow, equity growth, tax savings, inflation hedging, leverage, and investing with experts. And right now, I have the privilege of speaking with one of those experts. Today's guest is the Director of Investor Education at PassiveInvesting.com, the founder of ashwealth.com, and the author of Money for Tomorrow, How to Build and Protect Generational Wealth. Now, that book was published by Bigger Pockets. Everybody, please welcome today's guest, Whitney Elkins-Hutten, to the show. Whitney, welcome to the show. Today is the day. I'm so excited to jump into the conversation with you. And don't worry, I don't just say that to everybody either. Welcome to the show.
Well, thank you so much.
It's a pleasure to have you. You've got so much going on, so much experience in this passive investing world. Where do we start? Where do we start? I've got an idea. Let the listeners know who Whitney is. How about that?
Oh, okay. Well, I'm a Leo. No, just kidding.
Does that make
So,
you feel?
no, I started off real estate investing back in 2002 completely by accident. I bought a house with a significant other, and about a month later, the relationship fell apart, and I had a house, and I had all the bills associated with that house. So, stuffed it full, a bunch of roommates, completed the rehab on the property because it had green shag carpet, psychedelic daisies, walls in the wrong places. And completed the rehab and sold the house 11 months later, and made more money in that one transaction than I did in my public health job. And so that had me often traveling 80 hours a week. So I know a lot of people here are medical professionals. I was working for the CDC at the time, teaching doctors how to identify anthrax and smallpox cases. Remember, this is post 9/11. There was a lot of crazy things going on.
Yeah.
And how to, identify biological, radiological, and chemical incidences in their jurisdiction. So anyways, fast forward, I thought I had real estate all figured out. I thought that was amazing. Not every project went as smoothly as that first one. Had my trials and tribulations, throughout my live and flip and house hacking journey. And then eventually I asked myself the question one day, I'm like, how does somebody retire off of this? And that's when a friend of mine said, well, why don't you rent out one of those flips that you're doing? I was like, oh, genius. Why didn't I think of that? So scaled a 36 unit rental, 36 rental units, and realized I just had another job, quite frankly, at the end of the day. So repositioned that into larger multifamily buildings, and did pretty well at those type of assets, but decided I needed to go bigger, faster. So I kind of hit this inflection point and tried to figure out, like, do I now become the general partner on these assets, or do I invest as a limited partner in the assets? And quite frankly, I couldn't decide, so I did both. And at the end of the day, I will say I have grown my portfolio the fastest as a limited partner in various assets like multifamily, self-storage, express car washes, real estate debt. And that brings me to where I'm at today. I am the director of investor education at passiveinvesting.com. We help investors who are busy, like most of the people listening to this episode, place their capital into real estate assets and take advantage of the 5 different profit centers of real estate. And I also coach people too.
Coaching, that is, well, you talked about having a full-time job when you had 36 units, and it sounds like you've got a couple full-time jobs now.
But my attention's not divided. I'm full force into real estate. And so, whereas before I was trying to work like in public health and then also try to build my side hustle in real estate and be a wife, be a mom, right? And then just, keep my own oxygen mask on. I've kind of, for me, it was a big transition moment for me because that's what I went to school for, was public health, to help people. And so I really had to unhook my identity for how I created value in the world. And for me, I decided I'm an educator at heart. That's what I loved about public health. And I'm able to actually help people achieve certain levels of financial freedom, time freedom, choice freedom in their lives, and quite frankly, build what I call financial capacity. And I think, we talk about financial education being lacking in the world. For me, I actually see the inability to act on that education as a huge public health concern, because just imagine this. If everybody, most people have access to the knowledge on their at their fingertips, right?
As you held up your phone for the listeners, yeah.
Exactly, right? Like it's there, right? Like we're all connected. Like you want to Google something, like you can find it. But it's like, how do you put the pieces in the right order and become confident enough in your skills, create a plan, and then actually execute on the plan? I think that is the real public health issue here, because if we all knew how to do that, we wouldn't see some of these, public health issues that we are currently dealing with. I probably opened up a big box, Pandora's box there, but yeah, we can dive down any rabbit hole you'd like to there.
Awesome. And I just wanted to add to that piece, the knowledge, turning knowledge into wisdom requires action. And you never actually get into the problem solution cycle until you take action. Before you take action, there's just this spinning, there's nothing happening, right? But taking action is that difference maker. Yes, you unloaded a bunch there. I made a little bit, a few notes. One thing I just wanted to bring back is it sounded like you started in house hack. You went to single family, scaling that, and then you stepped into multis in a syndication style, wondering, hey, should I be active, passive kind of scenario? I love that stepping stone. So I just wanted to bring that back out. It's a great, like the way you learned active and passive through that process as well, too, is really cool. And you picked up on things that you wanted to do and things that you didn't want to do. And it sounds like it looks like you were able to create that passive kind of passion where you wanted to be. So you did mention 5 income centers from real estate. What did you mean by that, Whitney?
Well, so there's 7. So I'll touch on this really quickly. So one, you get capital preservation. So our buddy Warren Buffett says, invest to not lose money. That's the first rule. Second rule, see rule number 1. And what he really means by that is not necessarily being so conservative that you never take risk, but that you're taking an asymmetric risk and you're trying to invest in such a way that you do not get knocked out of the game, right? Because even if we invest and an investment goes sideways, like I have right now, I have a mobile home park investment, not going so great. 5 years in, if I can just get my capital back, I have not gotten knocked out of the game. Okay. Now, is that ideal investing? It is not. I will tell you that it is not. We want to invest to make a return. So that leads me to the other profit centers here. Investing for cash flow. Okay. I know a lot of people, especially high income earners are saying, I don't need the cash flow right now. I'm going to swing for the fences on a development deal or whatever. I'm like, yeah, but there might become a time in your life. One, the cash flow indicates that it's profitable right now into today's environment.
Mhm.
Two, what happens in a year or 2 years from now? You have a huge life event and all of a sudden you need to turn the tables really quickly. Now you can flip the cash flow on, right? So invest for capital preservation, invest for cash flow. Equity growth is another one. And we can get equity growth in a myriad of ways. We can get it through market appreciation. So just naturally the market over time steadily going up and to the right, if you're looking at a graph. You can get it through forced appreciation, meaning you're buying something with some sort of distress and you're optimizing the operational expenses on the asset, either increasing the income or decreasing the expenses or doing both. Or you can get tenant pay down, that type of appreciation, okay, or equity pay down, meaning where you outsource the loan to somebody else. So they're paying the principal, interest, and of course all the bills. Okay, and you get that type of pay down. Most of us do that with our primary residences. And then another profit center is tax savings. So how do we can, significantly reduce and create velocity in our portfolio growth by optimizing taxes. Now, here's the thing. Some investors get so latched onto this piece that they give up the other wealth pillars like capital preservation, like cash flow, like equity growth. Okay. The tax piece is number 4 for a reason. Because it should be kind of like the icing on the cake. That's why a lot of us love real estate, is because we can use depreciation to shelter the income. And then we have different accounting methodologies that allow us to amplify that through accelerated depreciation. And then right now we have a tax incentive bonus called bonus depreciation, to where we can fast forward that depreciation to the first year or 2 of the project. And then, of course, we've got our favorite monopoly type of depreciation, or like tax sheltering, which is the 1031 exchange, to help us kind of kick this can down the road.
Forever.
Potentially forever. Now, people, this is where I really kind of have people, if you want a step-by-step plan on how to put these puzzle pieces in order and what you should be focusing on at any point in time in your real estate journey, no matter if you're a new investor or an experienced investor, pick up my book, Money for Tomorrow, How to Build and Protect Generational Wealth. Because again, a lot of people start investing in real estate hoping to do the 1031 exchange. They make some late maneuvers in their portfolio, and then all of a sudden they've blown apart the whole thing that they were trying to protect, like towards the end, went right before they crossed the finish line. And then like one of the, we've got 3 other cost centers to kind of look at here, ways that you can make money in real estate. Just by the very nature of real estate, it can be if you invest correctly, it can be inflation hedging, meaning you can take the debt, lock in the debt in today's dollars, and then let time and the devaluation of the dollar erode the value of that loan. That's the classic definition. Or you can also think of it this way, as your expenses increase, you can also increase the income of the asset to cover the expenses, and that all gets passed through. So, we're seeing this today, rents rising, our insurance costs rising, our taxes rising. Well, what do you think that's going to do to rents? The rents are going to rise too. Okay. Now in certain areas, you're going to hit issues where you got rent control and then all these expenses raising, inflating. What's going to happen here? That's not a good picture for investors, or quite frankly, the tenant of these properties. And then you can use leverage to amplify your cash flow, but leverage can cut both directions, as we've seen in the past 12 to 24 months. Okay. So we want to make sure we're using leverage wisely. And then my favorite way is learning how to invest with experts. Okay. So either if you're going to be the type of person that it's like, I'm not giving a dime away to anybody, I am going to run my asset myself. That's great. That means you have to become the expert. Okay. You have to be the CEO, COO of your business, and possibly the CFO of your business all at the same time. And probably the day-to-day worker. Whereas you can learn to invest in other people's business. And so where you are the CEO of your portfolio and you're learning how to hire COOs to help you grow your portfolio.
Great. And that's the 7: capital preservation, cash flow, equity growth, tax savings, inflation hedging, leverage, and investing with experts.
Yes,
How did I do? Did I pass the test?
you did.
That's awesome. There's so much information there, though. I love it. I love the way that you articulated each one too, and you broke it down simply, easier to pick out. And for me, like through the years, picking these things up, and as you were saying that, it's like, oh yeah, there's this, and I did that, and that, and it all makes perfect sense. I love it. And the first time that you pick up this stuff and you take action. So you take this knowledge and you turn it into wisdom by taking action. It gives me goosebumps to think about, like it's out there. And you think, when you say it's a public health situation, it's like I look back, Whitney, when I was frustrated when I first learned this stuff because I was like, why didn't somebody teach me this? Like, well, I should have been taught this in high school. Why didn't somebody teach me this? But then I realized maybe I wasn't ready for it. I needed to become a different person before I could handle all of this, right? In high school, and everybody's going to be a little different. I say everybody's on their own journey. They've got their own stack of experiences. Maybe I wasn't ready at the time, but I'm ready now, Whitney, and it's so awesome to pick this up. You mentioned your book, Money for Tomorrow. And I congratulated you before the show. I want to make sure I do that here too, so everybody can hear. Who's the publisher on this book?
Biggerpockets.com.
Come on with it. That's awesome. That's awesome. Congratulations.
Thank you.
And another amazing platform as well too. And there's been so much growth and community, and it's kind of getting to that mindset piece as well too of, hey, there's an abundance of opportunity out there. And if we can work together, number 7, that you have invest with experts. And if we can work together and build that, just that community of like-minded individuals, I think it's amazing, isn't it?
Oh, absolutely. Yeah. And I want to kind of, drive home a point here. I mean, maybe you said maybe you weren't ready to hear like what you needed to do in order to kind of like launch on your journey. I think sometimes we also overcomplicate it, right? Like I've had this experience, maybe somebody listening here has had this experience. They had this massive, the reason why they don't pick up their first property is they have this like 100-point due diligence checklist and their head's spinning. They're like, oh my gosh, how am I going to ever work through this? Well, what is that checklist trying to do? Let's put it in a framework. It's trying to measure, how am I going to make money in these 7 buckets, right? And that's just one example. And so there's so many frameworks. That's really what I try to do, in my work at passiveinvesting.com, also in the book, is give people frameworks to make this whole investing, whether you do it actively or passively, less mysterious, less complicated, less, to borrow words of Bigger Pockets, less for somebody else, right? Because we're all busy. So how can we put it in a streamlined framework and then like get, nerd out in whatever area we want to.
Yeah. Framework is important. Understanding the purpose behind the process, really. And there's an old story. It makes me think of an old story of cutting a ham. I don't know if you've ever heard this. And every time we go through a process, or I teach a process, and then, if questions or if processes are usually living and we're learning and we're always pivoting. There's this, a young lady who was cutting a ham, and she's, the mom is teaching her, and she's like, okay, you grab your pan, you cut the ham here, you cut that off, you put it in the pan. And she's like, Mom, why do we cut the ham? She's like, well, that's the way I was taught. Right. And then her mom, that was teaching, it goes back to taught her mom. So the grandma, she goes back to the grandmom, and she going through this process says, her mom, why did you cut the ham? She's like, oh, well, it didn't fit in the pan. So through all of these years, they cut this ham just because the first time the pan was smaller, right? The framework of understanding the why and the process is really important. But that framework allows us to reduce down the amount of information required to understand, right? And that's so important. I think it's a great point. Looking back, feeling overwhelmed, I know there's a lot of listeners out there who are thinking, over-evaluating. But it also made me think, Whitney, of the process that you took too, by starting in these steps, reducing the risk in some scenario, like starting in single family. Hey, it's a little easier for capital preservation, right? In certain scenarios, right? You still got to understand the framework, but it's easier to sell, to get out, to get in. It's a lower barrier point, right? So using that framework to get in and say, hey, there's an entry point for everybody. There's always opportunity around us, and how we're getting into it is really important. If we keep the experts around us, people who are exceedingly going above and beyond in today's market, which we can talk about that now, keeping those people around you is really important. You talked about express car wash and debt fund. To me, this is like we're taking another step up here. And I love this because a lot of the listeners, when you get a certain point in your practice, you're able to sell your practice. And I think of this as a triggering event. And all of a sudden now, this is great. I've got an influx of cash coming in. But guess what? There's also an influx of tax liability. And when I see the car wash specifically, I think, hey, let's talk about this for a second. What makes a car wash different as a passive investment?
Well, I just to, touch on the whole tax issue. That's one of the reasons why one of our founders, Dan Hanford, got into multifamily real estate is, he owned, he's a chiropractor by trade and owns several, chiropractic offices and also non-surgical medical centers. And guess what? He had a tax problem. So
Yeah.
that's why he got into real estate. Now, as far as the car washes, it might be something a little harder for somebody who's never done real estate at all to jump into car washes. But to help people understand what you're doing is, with the express car washes, is what we're trying to do is to optimize a cash intensive business. So it's kind of like the next evolution past self-storage. So with express car washes, what we're doing is we're buying or developing sites where we also own the land, we own the brand, we own the third-party management company, and we're trying to optimize this as much as possible. And most of these acquisitions that we're doing, we're moving people away from, paying for the car wash, like paying $19, $20, $30 for one wash and vacuum. I mean, that's what it costs $30 for me to wash my car one time here where I live at a full service car wash. Whereas if I can go to an express car wash, now I get the convenience, the marriage of convenience of like something that's more of a self-serve model, okay, with that full service, high touch, environment. And I can optimize it using technology. So our clients there, our customers, they pay into a monthly subscription model. They get to come as many times as they want to wash, possibly vacuum their car, because that subscription, the barcode on their cell phone knows what car is being washed, what kind of wash it gets, does it get waxed? Does it get, dry? Does it get tire shines? What's in this package? And there's different levels of packages there. And so, this is a unique model where we're trying to take a very cash intensive business that's already fairly operationally efficient, but create even more operational efficiencies. For context, most of the acquisitions we do, the mom and pops, they're paying $2.60 for a car wash, between all the utilities, the water, the chemicals, and everything. The customer is paying $19, $20 a car wash. Maybe if they are on a subscription, they're paying $25 for their subscription or $35 for their subscription. We're driving down those efficiencies down to 83 cents per wash. So more than, lowering the expenses per wash by over 65, 70%. That's a huge margin capture there. Now, I think the next question that most investors ask is like, hey, like how many times did somebody wash their car? The average customer washes their car 1.8 times a month. So it's not like, so even if we can drop it from $2.60 a wash down to 83 cents a wash, and everybody washes their car 2 times every month, we still captured a net dollar in there. So that's huge. And this is really an industry that's growing. It's $38 billion and growing. It's a huge industry. And the sector that's growing the fastest is the express car wash. Now, here's the thing. I don't know where all the listeners are coming in from. Some people I've heard, they're like, oh my gosh, there's an express car wash on every single corner in my major metropolitan service area. Yeah, there's a lot of development. So just like real estate, it's location, 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 and then location, meaning we want to be in the right metropolitan service area, in the right secondary market, on the right street corner in that market with the right traffic pattern, because those are the things we cannot change fundamentally about the business. And so that's why, the cost basis to get in, if you want to develop one on your own, is probably $4 to $5 million between land and equipment and building and all that. So lower barrier of entry than it's say for like a multifamily building. But you definitely want to be with the experts in the space that know exactly where is the right place to build and scale one of these type of businesses. And so we love the secondary and tertiary markets because pretty like 95% of the United States has a car, and over 72% of the United States has more than one car in that household. So this is an industry that's growing, not retracting for sure.
Interesting. Now, I'm not a CPA, you're not a CPA, but what is your take on the actual depreciation process with a car wash versus, say, a single family or a multifamily?
Yeah, so in single family and multifamily, we are going to be able to depreciate that as residential real estate. So take your depreciation schedule, divide it by 27 and a half years, right? The service lifetime of the asset. And then if we do a cost segregation analysis on single family or multifamily, we can take anything that depreciates in 20 years or less, fast forward that to the first 5 years of hold. We can do a similar process with express car washes, but now remember, we don't have a piece of commercial real estate. We have an operating business where we own the real estate. So we are able to pretty much take that entire schedule, including depreciating the building in the first 5 years. We can also layer on that tax bonus, which right now in 2024 is 60% bonus depreciation. So, for my investors going into an express car wash this year, you're probably going to land like right around 65% bonus depreciation or total depreciation for year one. So very attractive. However, this depreciation is generally going to be captured and held within the business level, meaning you're going to be able to use this to offset the income. Probably for most investors, especially if you still are working your full-time job, you're not going to be able to take that and use it against other assets like multifamily or self-storage or, your single family rentals.
So that, again, we're not accountants.
Not accountants.
Experience that you're saying that loss from the car wash wouldn't be able to offset, say, the sale of a practice?
That's different because that's business. And so partner with your CPA because that might be eligible for sure.
Bam, time to buy a car wash.
Time to talk to your CPA.
Yeah, right. Wait, there's this order.
Before you sell the practice.
Capital preservation, right? Yeah. It's an important one. No, but just in my mind, putting that together, you are absolutely right. And the thing is, just like our health, Whitney, there are preventative and proactive measures that we should take. In these things, you got to talk about, have those questions. Triggering event. What happens? I'm setting this business up so I can sell it, right? Eventually, maybe if I want to sell it, what are some things that I should do along the way? Talking with your CPA, a strategic planner, not just an accountant as well, figuring out these things. And I want to dive a little bit more into one more topic here, Whitney. This debt fund. I am like a first grader when it comes to debt fund. It's something that I've heard of a lot in the current market with a couple of different fund people. And there goes my intelligence right there. I call them fund people. I don't know. Help me understand this from the layman's perspective. What in the world is a debt fund?
Well, fund people sounds a lot very close to fun people. So bring it on. So In the past few years, we've been in the part of the market cycle where it's made sense to invest in at the equity side of a deal, right? Multifamily, ramp up of multifamily, self-storage, right? But we're in the part of the cycle where cash flow has been compressed, asset prices are still high, interest rates are still high. What is doing really well right now? If you're the bank, you're doing pretty well, right? Because you're able to charge a higher interest rate, especially get a higher spread and probably higher fees. And so debt fund right now is kind of having its heyday, real estate debt. But just like, on the equity side of things, there are all different flavors of debt funds. Okay. For us, we like being extremely conservative and plain Jane, very straightforward debt fund, no like, how are we using debt to buy like 6 different asset classes and blend a arbitrary increased return and then leverage the debt fund in order to go get more money so we can lend out more? All of that creates risk. We're trying to, put out there a limited risk. I can't ever say risk-free. I mean, anybody says risk-free, like that just doesn't exist.
Yep.
But for us, we raise capital from our investors, and we take that capital and we deploy it through our rehab wallet lending arm to fix and flippers in residential real estate, primarily in the Carolinas and in mostly the southeast part of the United States, but primarily the Carolinas. And we have over 40 years of experience between our managing director and our managing operator there to be in lending, and not only lending period, but also lending in the Carolinas. So we're extremely familiar with this market. And we're taking that first lien position. So something goes wrong on the asset, we either get paid off first or we get the asset. Mm-hmm. We're not competing with any other loan positions on the asset. We're underwriting the borrowers, very thoroughly. Most debt funds, they target a 1% to 2% default rate. Our target is 0%. Right now we're at 0.002345, like under
so
100.
That one person.
We've had out of over 1,500 loans, we've had 3 defaults.
Yeah.
So whereas most lenders would have had at least 10 to 20 defaults on 1,500 loans. So we've lent to date over $309 million through our rehab wallet lending arm. Anyway, so we've gotten really efficient and proficient in this category. But this gives the investor a unique opportunity to, 1, take advantage of the interest rate environment, 2, get their money out of the bank and put it into an asset that's backed by real estate. That also creates liquidity for them as well. Or if they want to lock up their funds for longer, they can get compounding. So for investments, 100,000 and under, right now we're offering a 6% preferred return. Between $100,000 and $500,000, it's an 8% preferred return. Both of those tiers have a 0 lockup on them, meaning you can invest with us and you need your money back. You just let us know. We've got 90 days to get it back to you. We often get it back much less than 90 days. And then over $500,000, we have very short lockup periods and the preferred rate goes up from there. But you can take the monthly distribution, you're creating monthly cash flow with it, or you can allow, if you don't need the monthly cash flow, because we have a lot of people here, they're high income earners, they don't need it quite yet, allow it to compound for you. I oftentimes show a graph for people. If you invest $100,000 at 8% and allow that to compound for 10 years, your effective rate of return at year 10 is over 17%.
Compounding monthly or annually?
Monthly.
Monthly, okay.
Yeah. So anyways, yeah. And like, it's just a hair's difference between compounding monthly and compounding annually. But long story short, you're now earning a 17% return on that money by year 10. So it can be a great tool, again, for somebody who wants to start transitioning their portfolio or part of their portfolio into cash flow, wants to reduce that sequence of return risk in their portfolio, or it's just you just don't know where to invest right now. Get it out of the bank. Instead of earning 3 or 4% at the bank, let's get you 6 or 8% in a real estate debt fund.
That is awesome. And if the listeners want to learn more about the debt fund or passive investing in general, obviously they can check out this book that's available on Amazon, Money for Tomorrow: How to Build and Protect Generational Wealth. Simple. Check it out on Amazon. I love it. Congratulations again. I know that's such a feat. That's so awesome. But how else can the listeners connect with you, Whitney?
Yeah. If you're interested in passive investing, probably the simplest way to get a hold of me is at passiveinvestingwithwhitney.com. There I've got some free tools for you to engage in. Also, you can get some time on my calendar. We can talk all things passive real estate, and you also get to see our open deals.
That's amazing. And I will include that in the description. I've got one more question for you, Whitney. It would be if you could go back right when you had that life experience where you've got this property and you ended up house hacking, basically. If you had all the knowledge that you have now and you were sitting next to somebody, maybe that person is listening today, what would you tell that person then if they were a similar path as Whitney, maybe in the public health, maybe in medicine, and wanting to help people, but you knew that there was something there with real estate? What would you tell that person with the knowledge that you have today?
Well, that's why I wrote the book, Money for Tomorrow, because I wanted what was the plan? What would be the plan that I would want my 20-year-old self to know? I wanted my daughter to have that plan moving forward. I mean, I plan to be here for a really long time. I'm doing everything I can for that, but you never know, like life can happen. Life can have different plans for me. So if you want that plan, it's in the book. For me, how I think about it and how I coach people is like, how can you make the roof over your head your first investment property? I stumbled into that completely by accident, and I'm so thankful for that experience. But I think, having if you can learn now how to make that first, your home, your first actual investment. And I don't mean just go buy a home, right? Because that's not your asset. It is an asset, but whose asset is it? It's the bank's. In order to make it your asset, you have to learn how to outsource the principal, the interest, the taxes, the insurance to another entity, like roommates, like build an ADU, an accessory dwelling unit on their property. Maybe you, if you travel a lot, like we travel a lot, we do Airbnb and VRBO in our house. Like we rent it out. And then that would be kind of number one. And then how can you stepwise level up into your next investment? For me, I love doing things passively. I want my time back, my choice back, my freedom back. But some people are like, very few people I meet actually should be, managing their own real estate portfolio. But if you are that person, you don't have to have 1,000 doors in order to be able to do that. You can get a hugely long ways by just buying 10 fourplexes, right? But it's, how can you use
You
the
say
skills
that like it's so easy. Just buy 10 fourplexes.
I didn't know. It's
Yeah.
simple.
Yeah.
It's simple, but it's not easy.
Yeah. Yeah. Yeah.
The mechanics of it are simple. Most of us have that translatable skill already,
Yeah.
right?
It's
That's
all about the
why
framework. Yeah.
it's all about the framework. Okay, I've already done this. Okay, how can I add just a little bit more complexity to the next transaction? Okay, I got that done. How do I add a little bit more complexity to the next transaction? But I would say, how can you make that roof over your head your first investment?
Yeah, yeah. It's the purple book, Mr. Kiyosaki, right? Money in my pocket versus money going out of my pocket. I love that simplicity of that framework, the difference between an asset and a liability. 100% on it. I love the journey from house hack now to all the way into debt funds, helping other people. And you found that, it feels like you found that sweet spot in life, Whitney, where your passion aligns with that income generation piece. And now the ability to share that with others is amazing. And we thank you for that. We thank you for your time today. From me and all the listeners, wow, it's been a great conversation. Thank you so much.
Yeah, my pleasure. Thank you so much for having me on, Brett.
Absolutely. We're going to check out that book, Money for Tomorrow. We're going to find you on passiveinvesting.com, right? Passive Investing with Whitney. .com. We're going to have the listeners go and check that out. And to the listeners out there today, thank you so much for your time. And as always, your attention, giving that to us today, whether you're in the hospital, in the office building, maybe you're exercising, walking around. We thank you for your ears, your listening, your attention. It's always a pleasure. If you have any questions, reach out to us. Until next time, this is the Real Estate Mogul MD. Thank you.